Hello, hello, hello. Welcome to the channel. I'm so happy that you all have decided to join us today. As the title says, I'm getting ready to peel back the curtain and let you all see why investing has changed our life and how it was able to change our life without making us go BROKE broke. Um, Now, of course, I am being a bit vulnerable here because literally, as the thumbnail shows, I'm about to show you how we got into investing 4 years ago. We're going to do our full portfolio reveal. So that means we will be talking about companies, etc. Basically, what's in our portfolio, why we chose to buy that particular company or fund, and we just gonna let it all hang out there. However, again, this is our own personal journey. So of course, I'm gonna have to hit you with, our financial, disclaimer because I'm not a financial advisor. Again, this is just our own personal journey. So again, as we said, look, after 4 years of investing, we're about to dive into our exact portfolio, how it's performed, for you to see how it went from $48,000. Now, that's over the course of 4 years. That's how much we contributed to our various accounts. But basically, how that $48,000 ended up turning into $113,000. So, if you're ready, strap in and let's go ahead and get into it. All right, so first, I figured it would be beneficial to say, okay, you got a thumbnail that says you got $48,000. Where does money come from? Well, it came from all the various jobs that we've had throughout these last 4 years, going all the way back to 2020. First, we did open up, it was just one traditional, an IRA does stand for an individual retirement account. Basically what had happened was the employer that uh, the employer that we were working for, they ain't have no 401k. So um, in 2020, funded a single traditional IRA. That means we were able to get a pre-tax, because that money goes in, quote unquote, pre-tax. Then when we filed our taxes, we were able to get a credit for that. So anyhow, we put in $6,000, and as you can see, we didn't put nothing else in this traditional IRA account. And so now that particular account, when I looked at the balances as of market close this past Friday, we're just a little bit under $9,000. Now, the bulk of our money in 2021, we decided instead to go ahead and fund Roth IRAs, so individual retirement accounts. So Roth IRAs for both of us, because again, people that we was working for, they ain't have no employer sponsored retirement accounts. So we were looking at this from the standpoint of, okay, when you contribute, because a Roth IRA is basically money that you contribute after tax, you've already paid the tax on it, then whatever growth you see is tax free forever. Now, of course, you do have to hold the account for at least 5 years. You have to be a certain age before you actually start taking money out. But again, if you want to maybe have a little bit more, if you want me to go into more details about the whole difference between a traditional and a Roth IRA, quite frankly, that could be its own video. So if that's something that you're interested in, just let me know down in the comments because, like I said, I don't want to, get too off track here because today we talking about the money. So basically, 2021. We have two accounts, one for me, one for my spouse. So $12,000 went in for 2021. We maxed it out. In 2022, we did the same thing, $12,000. We maxed it out. Now in 2023, we did not max it out. So we got to about three, you might as well say about half. But that's just me being nice rounding it up. But like I said, just for nice round numbers. So basically about half of the amount that we were able to put in for that tax year, we did. Now, for us in 2023, we were focused on getting out of consumer debt. So basically, we got rid of our credit card debt, and that was what was important to us. So, boom, it is what it is. Now, as you can see, for 2024, I don't have anything in here because actually in 2024, I started a new job. And so remember, we were just coming off of basically working for an employer that didn't have any sort of employer sponsored retirement accounts. So what was most important to us was we said, okay, hey, now that we, you know, have a job that, has a 401k, we need to start putting money up into that because depending on who you work for, my particular employer, they do, if you decide to put some money away, then they will match you up to a certain percentage, up to a certain amount. So I was like, look, I'm trying to get that match money. So basically, um, that was the focus in 2024. Now, how IRA contributions work, um, if you're doing like a normal contribution, you're not doing no backdoor stuff, you're doing the normal contribution, um, the tax rules actually allow you to contribute all the way up to the tax deadline. So even though we are already in 2025, if I wanted to, and if the math, if the money was working right, we still have until April 15th to actually do a contribution technically for last year. So, like I said, we'll get into that later, but as of right now, I haven't done that. Um, and I'm not quite sure if I am going to do it just because we have other priorities. But again, we can get into that later. So, all right, boom. So then, basically, for the 3 years that we had our Roth IRA, basically that ends up being us contributing to just over 29,000, so just under 30,000. Okay. So then, just like I just said, in 2024 I started a new job. This was how much I contributed. So basically, I only contributed enough to get the match. So my employer, if I contribute 8%, then basically I get a 4% match from my employer because my employer matches 50% up to 8% contribution. So basically, when you do the math, it's just 4%. So that's what I put away for 2024. And then obviously we're in 2025. That's what I've put away thus far. Also, um, my employer, uh, once a year, they do a 3% retirement contribution for everyone, even if you decide not to contribute. So, whereas this first one, in order to get the match, you have to contribute money, you have to have skin in the game. But this other separate match, which is 3%, technically you don't have to have any skin in the game. That the company is just going to go ahead and put 3% away for you, and it's going to come out of their money. It's not going to come out of your paycheck. So anyhow, with that, having an employer, they do have a 3-year vesting. So this $12,000 um, that I contributed thus far, my quote unquote vested balance is actually just a little bit under 15,000. When I include the match, then the current balance shows on my statement as just over 25,000. So when you do the math, our cash was just over 48,000. And so the current balance, if we look at the match that I get from the employer plus the change in the market value, our current balance is just over $113,000. Now, to me, it was very important to have the match um, be part of the change in the market value because, again, that match off the rip, as long as I put money in, I'm going to get a 50% company match in my 401k. And I didn't have to do like anything extra other than put money away from myself. What makes this so big, though, because when you do the math, basically this is a 135% overall return. Well, because we're getting ready to get into our actual investment portfolios, you're going to see that we had a 200 plus for one of our um, for one of our investments, which was where we had put a lot of our money in. One of our investments had a 200 plus return because of the fact that we decided to seize the moment from that 2022 market drop, right? So in 2022, market was dropping, the news, everybody was panicking. But again, from a long term standpoint, if you decide, hey, from a long term, I believe in certain either companies or funds, then when the market goes down, there's a huge opportunity for you to go ahead and basically cash on in. You buy it as the price is falling, because you're never going to time it. You're never going to time it to get it at the very low price. But again, you're going to be buying it much lower than when it was at its market high, and then you just be patient and you ride it on up. So this is the total. Now again, if I just wanted to um, ignore my company match and just really hone in on, okay, what's the vested balance, since I would have to stay in my job for 3 years in order for me to get all of what I'm going to get from a standpoint of a current balance. I have to stay with my job for 3 years. Right now, I'm a remote worker. I've got some really cool colleagues. I like the work that I'm doing. Yes, there are times, just like anything, I may get frustrated, but overall, I like the work. I like the company that I'm working for. So, unless things just really hit the fan and mentally I can't handle it. Like I said, something very extreme would have to happen, because I do 100% believe protect your peace. I protect my peace at all cost. So, as long as nothing crazy happens at the job, I fully do plan on being with this company at least for 3 years, because I want all my money. Because even though they are matching what I've put in, oh, trust me, I want all my coins. Okay. So that's that. Now, if we were to look at just the Roth portion, so again, this is the money that we have contributed after tax, and then our money grows tax free forever until we start pulling from it. You'll see that we invested a little bit under 30,000, and yet the current balance of that now is just over 78,000. So again, that's 78,000, so that's almost an additional $50,000. So we got just shy of $49,000. That gain is tax free. We ain't paying taxes on it forever, ever, forever, ever. So again, you can probably hear in my voice my bias towards Roth. And if you look at my earlier video where I just did my budget closeout from January along with the first February paycheck, you see that I did switch over in 2025. I switched over to um, a Roth 401k. Last year, I was contributing to the traditional 401k, so that means I got a pre-tax perk last year. But yeah, starting this year, I'm trying to put as much money in Roth as I can. So now let's move on to the juicy parts. So okay, I'm gonna have to go into two different accounts. Um, but thankfully, everything now is in Fidelity. When we were in the midst of putting all this money together from 2020 to 2023, I mean, we had accounts at E-Trade, um, at TD Ameritrade. Actually, we even had accounts at M1. It was we had accounts all over the place. And it was probably because different companies was doing different specials. But um, as we were getting, close to 2024, I was just like, man, for the most part, me and my husband were always together, but um, if something was to happen to either one of us, the person that's left, like you, we want it to be as easy as possible for that person, as seamless as possible. God forbid something happens to one of us. And so, basically, in April of last year, that's when um, we started to go ahead and change everything over. One of the reasons why we did pick Fidelity is because we knew that with me starting the new job, that the employer 401k was going to be in Fidelity. I knew people, I had friends who worked for this particular company, so I knew Fidelity was the sponsor. And so I was just like, okay, you know what? We just about to make things as easy as possible and only have one one quote unquote, broker for all of our stuff. So again, that's just my own little share. So I'm going to go ahead and close that out. Um, so anyway, as you see, just like with the normal bank account, you can change the name. So like I said, I just love that for the Roth. We ain't ever gonna be paying no taxes. So this particular um, account that we're in, this is quote unquote my account. So we do. So see you see we up in here because again, this ain't no cap. We not lying over here. We showing it all. So yeah. So anyhow, we do have a joint brokerage account. Now I'm going to come back to this. But right now we're not actively contributing, to this account. So like I said, just bear with me. So we're going to go into the Roth IRA. And again, IRA stands for individual retirement account. So it can only be one person on the account. And so this is the position now, even though now there's only 100 shares left in there. Previously, when we were putting in money in 2021 and 2022, all of our money was going to buy specifically T triple Q. So now I'm a switch over a little bit. We gonna get into some stock charts. Okay. So this is my trading view account. Like I said earlier, I know how to trade, and I did have some FOMO going back to 2020. FOMO in the sense of, or I guess, well, at that point I had already missed out, but it was one of those like lesson learned, ha ha, aha moments for me, right? So while in 2020 I was focused on that fast, quick money, day in, day out, I said, you know what? When the market hit dropped 20%, so just so you know, this is the Q, so this is basically the Nasdaq. But yeah, I've got, a bunch of symbols that I follow depending on what exactly I'm doing. So this is the Nasdaq, that's basically the tech stock. This is the SPY, so this is the S&P 500, and then, the Dow Jones. So anytime that there is a 20% drop in the market, of course, the news goes crazy. People usually panic because, that is a lot depending on, what you got. It don't matter how much you got. Seeing a 20% or more drop in what you quote unquote had in your account and how it makes it look like that it's gone, right? Because I mean, technically, you don't lose money until you actually sell your position. But sometimes people say, you know what, 20% is too much for me. I just want to go ahead and get out of this position. But anyhow, look at what happened, right? So this is the COVID drop. And then let me get a little trend line going right here. So after that big drop, if I just draw a trend line, And what I'm looking for is I'm looking for multiple touches. So I have this particular wick. I have one, two, three, four, five, right? But still, at one point it was down here, which again, nobody is ever gonna perfectly get when a stock goes down, you're not gonna be able to get the perfect price at that 164.93. But regardless, this sucker in like a year, you might as well say, when the high was 408. So I said, okay, hey, from a long term, and trust me, 1 year is not long term at all. But from a long term standpoint, I had to go ahead and give credit to where credit's due, right? So Warren Buffett, a lot of people follow him. A lot of people like to um, talk about, certain quotes. This number one quote got me. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. Sorry about that. So I took that as, you know what? Yes, nobody likes to see red days, but there are certain times where we have these huge dips in the market. In the news, they'll call this quote unquote bear territory. It's a bear market because the indices have dropped like 20% or more. Um, but again, when you ain't when you're not focused on that quick money and you talking about, okay, certain companies, certain funds that I like for a long period of time, this is the time to not be thinking about the short term. For me, in my house, it's our time to be thinking about the long term. So when we was putting money away all in 2021, because clearly in 2021, right, the stock market was going up. We wasn't buying, we wasn't trying to chase. In 2022, then the stock market started going down. And then once it hit 20%, oh, your girl was happy because again, I remembered this quote from Warren Buffett. And then because of the fact that we had been putting this little money away, like I said, however you do the math, on a monthly basis, it was working out to a few $100. It makes it seem like it's not that much. But again, if you if you commit to yourself and you put yourself first for the long term, you can then set yourself up, right? Because I didn't know that the market was going to drop again in 2022. We just had a pretty decent drop in 2020. Yeah, it was short-lived, but it was still over a 20% drop. So boom, boom, here you go. What we were doing in the financial world, they say, okay, they was getting a dry powder together. So dry powder, what it's and it refers in the financial, it refers to liquid assets that a company, which I'm not a company, or an individual holds, primarily to cover future obligations, undertake new ventures, or navigate through financially turbulent times. The term is often used metaphorically to describe cash reserves. Dry powder provides a safety net and a tool for strategic financial planning. All right, so I want to go down here to the investment opportunities. Dry powder is also accumulated to seize unexpected investment opportunities. These opportunities could arise from market fluctuations, sudden changes in asset valuations, or unique situations like distress sales. Investors, right? So here we are, we're investors, right? We've been socking money away 2021, 2022. Investors with ready capital can quickly take advantage of these situations, often securing deals at an advantageous terms. So, okay, well, now let's do the math. If each account, because these accounts are not together, so if each account has 6,000, and then, like I said, when the market was by time the market had dipped 20%, you're talking about like summertime. So in the summer of 2022, we didn't have all 6,000. We had like 3,000. So basically, we had accumulated almost $9,000, you might as well say, in each account. Well, if I am somebody who likes tech, but if I only got $6,000 and yet this particular, the Qs are costing like 175, 200 a share, well, we can quickly do the math, right? 6,000 divided by, let's just say, 200, because again, I'm not Miss Cleo. I don't know that it's going to go to 175. That means I can only buy 30. Now, technically, if I ain't got none, 30 is better than none. But because, I knew about trading, I also knew about this three-time leverage, what's called the T triple Q. Now, again, as I said before, this is not investment advice. I'm just telling y'all what I did and I was able to do for me and my family because we got educated and we learned about trading. We learned about investing. So, like I said, these leverage, when you get into leverage type of offerings, that's a whole nother beast. Fidelity even makes you sign sign additional paperwork because again, it's not for the faint at heart. So anyhow, I said, all right, well, then when you look at this T triple Q, well, now this T triple Q, it quote unquote cost less than the Qs, right? So now you're talking about back in 2020, this thing went from like 29 to looks like $8 or whatever like that. I think they had a split, so it didn't really go down to $8 when it was in 2020. But anyway, here I am in 2022. So I see, okay, well, before, because this is triple leverage, you can see almost when the Qs had like a 20% drop. Well, T triple Q, because it's triple leverage, almost had like a 60% drop, right? So I said, okay, well, now, at the time, obviously I was paying attention to the market. And so as we headed into 2022, the market starts falling. And I said, now we got, the numbers of course are different, but when you look at the percentage, you're over here again where you've got a 50%, almost 60% drop. And so you'll see this circle because in June of 2022, obviously I had a conversation with my husband and explained to him the situation. And we agreed, yep, you know what? We're going to start buying a T triple Q. Now, normally the pundits will say you don't do this because they say that this particular fund is not something that is supposed to be held quote unquote long term. You're really just supposed to day trade this. But again, you know, we did our own research and ultimately we decided, yep, this is what we're going to do. So I think probably in my account, so it looks like, let's see, it looks like um, dollar cost averaging in, I had a $26.62 um, um, cost basis. So I'm pretty certain when I first started buying up shares, I was buying shares at like 30 bucks or whatever. And as it continued to drop, because then I was buying in June, July, like then I started buying on a monthly basis, right? Because I'm dollar cost averaging. Um, when it got to September, so here's the difference. When it got to September, you'll see this puppy still kept on. So even though I bought in like around here, and then I bought in a little bit more, a little bit more, a little bit more, you see this sucker dropped all the way down to 16 dollars. Do you think that I was upset that when I bought it at 30, now it was at 16? Nope. I was not upset at all. Why? because I got greedy. I was greedy. I was like, oh, okay, well, shoot. I like T Triple Q at $30. You know, I'm darn sure gonna love it at 16. So I had added to the position. And again, me and my husband, we had already talked about it. That was our strategy. We wanted to, within both of our accounts, we wanted to have enough T Triple Q such that in total, we had bought 1,000 shares because, again, we're trying to maximize our position. And so ultimately, in my particular account, I think I had gotten up to like 300 and something shares because, again, if you then do the math of like 300 and something times this 26, you're going to get like a cost basis of like 9,000 or $10,000 because remember, we only had but so much, in our Roth IRA at that particular time. And so then what happened, right, is okay, so now we've secured our position and then we just proceeded to hold it. So it still went down a little bit, but as we started to get into 2023, the stock market started to turn, continued, and again, since this was an investment where we had planned to hold this position for a long time. And so, of course, we get into 2024, it's still continuing to rise. And here we are in February. Technically, if I was to draw this even more, because there's another touch. So, like I said, it's even still continuing to rise. But again, for the purpose of this illustration, I'm just showing y'all. And I realize I'm going into a lot of detail, but like I said, I'm telling you why we did what we did. So at this point, right, we have we start to have, because it's one thing to be up 100%. It's another thing to be up 200% and more. So again, you have to decide, okay, at what point do you start taking some profit, right? Because as a trader, we know all about market cycles. We know how, this technical analysis work. I know what these various uh, candles mean individually as well as when certain patterns happen. So again, my husband and I, we had already decided, hey, look, once the position hits 200%, we're going to start taking profit. But because we have such a good cost basis, right, we are going to maintain 100 shares in each of our accounts. That's just what we're going to do, and we're just going to ride it out till we can't ride it out no more. So with this additional 200%, so before, back in 2022, we only had cash and T triple Q. So back in November, which is why I stopped my line here, once the price got to 82, it was 82.20. um I sold whatever 200 and whatever 24 shares or whatever like that, and then I'm left with 100. And so similarly in my husband's account, we did the same thing. We sold the balance of the shares and we just kept 100, and we still have this fraction because T triple Q does pay a dividend. So we have our um, various accounts set up that whatever we invest in, when we get dividends, instead of taking the cash, we just have the dividends reinvested back into. So this is a partial, share. So anyhow, with the profit that we took off of T Triple Q, um, I decided to put money into two other funds. One is SCHD, that's the Schwab um, U.S. dividend equity. So basically, that's a lot of like that's pulling from like the Dow Jones type of companies that make up the Dow, and then FEPI, which is basically some tech again. But again, this particular fund, like I said, this fund, just like T Triple Q, actually, I would say this fund is even more aggressive than T Triple Q. But again, in our case, we know what we know what we're doing. And you can see, we decided, okay, hey, we're not. So even when I switch over to my husband's account, you're going to see that there's FEPI in there as well. We don't have SCHD in his Roth because he has SCHD elsewhere. But from a FEPI standpoint, because this is a very high dividend, this is a very like uber aggressive um, type of fund. We did max, and we said, hey, we're not going to put more than 10,000 in this particular um, fund. We're not going to go, basically above 10,000. So the 200 shares, it ended up being just a little bit above it, but ultimately, um, we'll have our 200. And yeah, this is actually a monthly dividend payer. So for these 200 shares, if FEPI continues to pay out the dividends that it currently does, I'll make 2,400. Well, I'll receive $2,400 just about in dividends. But again, I do have dividend reinvestment on. So these are the three funds um, that I have in my Roth. And then as you can see, I am still keeping some dry powder. I'm still keeping some cash because I do, like I said, I've got stuff on the radar, and just waiting for the opportune, time. Because like I said, clearly I've shown that I can exhibit patience. Okay. And then the next account is the retirement savings plan. So the bulk of the money is in, basically, because in the retirement savings plan, they only do like mutual funds. So this would basically be the equivalent of the SPY. And as you see, the majority, like 95%, you might as well say, is invested in the SPY. And then the other 5%, I did decide to um, buy company stock. Um, Normally, I wouldn't, but in this case, the particular company that I work for, if I did not work for them, I know that I would have a position for them, like within our investment account. But also, it ends up being a two-way sword. So even though if I wasn't working for them, I would likely have more than 5% um, stock. But because I realize that they are my employer, my paycheck, my bonus, et cetera, is all tied to them, then I'm just like, okay, even though I like the company, I don't want to expose myself too much because technically I'm already exposed by having to rely on them for my paycheck and stuff like that. So that's just that. So anyhow, my retirement looks like I'm at like about an 8% return overall. You see in the Roth IRA, I'm at like a 33% um, return overall. And then in the joint account, so this brokerage account, I said we were going to come back to this. Well, if you notice, similarly, right, even though we're not doing much with this account right now, meaning that we're not actively putting in like a bunch of money or really any money on a monthly basis, this was an account that did have some money in it. And uh, T Triple Q, it did pull back this particular in August. It had a nice pullback. And so, yeah, having some of that dry powder. Now, again, I didn't get a huge position. It's only 25 shares, but I was able to buy this at 51.61, and you can see the 52-week range. The low was 48.80, so I'm kind of like down here. And thus far for the year, the high was just under 94 bucks. So, and right now, the last price on Friday was like 89 bucks. So, as you see, I have a 70 74, or rather we, because this is a joint brokerage account. So unlike the Roth, right? Um, anything that we buy in here, when we sell, depending on, for instance, how long we have had the particular position, but regardless, whether it's greater than a year or less than a year, we gonna have to pay taxes on these gains. But see, remember in the Roth, all these gains, yeah, I ain't got to pay no taxes on it. So anyway, that was that. Okay. All right. So with that being said, grand total, as far as under my name, is just about 56,000 overall, at about a 21% return in that case. So now I'm gonna switch over to my husband's account real quick. All right, so now I'm over in my husband's account. Obviously, Fidelity is reminding us that the stock market will be closed. Well, the US, the major stock market, like the New York Stock Exchange, et cetera, that's going to be closed in observance of President's Day. So now you see over here, of course, because it is a joint brokerage account, you'll see that same account. But then see for my husband, he's got a traditional IRA and again, a Roth IRA. And like I said, I just love titles, so no taxes ever, ever. So again, we won't have to rehash through our joint brokerage account since I literally just finished that up. But as you can see for him, in his traditional IRA, he already has SCHD in it. And so um, he's got just over 300 shares. But basically, just like, we went back to the uh, the Excel sheet, this is that traditional IRA where we contributed $6,000 in 2020, and now the current balance is just over 8,800 bucks. So similarly with the Roth, the difference is, like I said, T triple Q. Now, in his case, when we would have been, buying in, like I said, it's not like, you just know like the magic number or whatever, but his cost basis was a little bit more, 2807 a share. And like I said, we were able to get up to like I want to say like maybe 624 or something like that when I was looking back at the statements um, and stuff like that. So, of course, with him having a higher cost basis, then that means that his total gain percentage is a little bit less than mine, but still over 200% nonetheless. And then clearly, because his account had more shares, well, then that means that when you did the math, now back then, I think I was also able to sell his around the 82 or 83 dollar range as well. And so in this case, again, he already has a SCHD position. And with this being a traditional IRA, that means that eventually we will have to pay taxes on it. So we don't plan on putting like any more money in there. Plus, like I said, the circumstances have changed because, you know, hopefully, our like I said, the circumstances has changed. So again, we're not going to be contributing anything else into this traditional IRA. So the SCHD, it does have dividend in its title. So every quarter it pays dividends and then it's just going to reinvest. So in this case, we didn't feel the need to put SCHD in his Roth. He has a similar 200 um, 200 share, basis in FEPI. And also, it looks like we were able to get this around the same price. So he's got a similar type of cost basis where basically about $10,000 is in FEPI. And we're just gonna go ahead and ride this out, clearly because he would have had more shares of T triple Q when it was time to sell. That means he's got more cash that's been holding in his account since, like I said, I did that sell back in November. But again, like I said, we have, we have our eyes on a couple of different um, funds or stocks that we're just waiting patiently. And once that happens, we will go ahead and deploy that money. So again, this is all about dry powder, being able, we have ready capital that if we need to take advantage of certain situations, um, we're we're ready for. And so then in this case, again, now I don't double count this because, the joint account, like I said, it has both of our names on it. But when he sees his account, he's just over 60,000 with about a 34 overall, like I said, return when you do the math and stuff. But again, we're very happy for, where we are, because you gotta start, somewhere. Um, I'm sure if you talk to either one of us, yeah, we'd probably be like, oh yeah, sure, in our 20s or 30s, this would have been great to like start. But again, you just got to give yourself grace, and we don't come down on ourselves on, oh, why didn't we do this, or why didn't we do that? You know what? We know about it now. We're doing it, and here we are in 2025, just like we were back in 2020 and 2021 and 2022. We was getting our ducats, together to be ready to deploy our money, to have our money working for us while we work and also while we're in the bed sleeping. All right. So yeah, so that's, how we were able to grow our portfolio from 48,000 to just over $113,000 over the last 4 years. It's been a learning experience, for sure. Lots of lessons that we've learned along the way. And again, just to repeat, I'm not a financial advisor, just, someone that's sharing, what's worked for me and what's worked for us. So if you found this helpful, please hit that like button and subscribe to follow along as we continue to share our journey. Again, in the comments, um, let me know if you want me to go into something perhaps in a little bit more detail, because again, even though I'm not a financial advisor, clearly I can talk about my own, you know, our own experiences, especially like along this whole investment, journey. So otherwise, hope you, enjoyed the video. Thank you again for your time and spending time with us. And we hope that you'll subscribe. But we hope that we'll see you in the next video.